The Federal Reserve doesn't actually control your mortgage rate. That power belongs to a massive global money machine called the yen carry trade. To see how Japan dictates American borrowing, imagine an investor buying a 4% US bond using entirely borrowed cash. They skip borrowing in dollars and go to Tokyo. For decades, Japan artificially pinned its interest rates to the floor, so the investor borrows millions in yen for nearly 0%. They convert that cheap yen into dollars and buy the higher-yielding US bond, pocketing the massive difference as pure profit. This free money loophole pumped trillions into US debt, keeping our interest rates low. But this massive money-making machine relies on one fragile assumption. Japanese borrowing costs must stay at zero forever. And recently, that assumption broke when Japan raised its interest rates. Suddenly, holding that borrowed yen becomes much more expensive, wiping out the investor's profit margin. To pay back those now expensive loans, investors are forced to mass sell their US bonds. And with global demand plunging, the US government must raise long-term interest rates to attract new buyers. So as this massive cross-border trade rapidly unwinds, even if the Fed cuts short-term rates, that evaporating global demand is exactly why your mortgage stays high.